YouTubers, Mike Martin's here, Mike Martin's channel. Yes, yet another better dwelling article. I missed this one, but it's important. We got to cover this. Canada's considering a risky move to fund more mortgages with foreign capital. What are you out of your tree? You're selling. The whole country sold out. New Zealand sold out. Australia sold out. Jamaica sold out. UK sold out. US. Well, U.S. has Donald Trump, and he's really trying to not sell out to foreign money. But what is going on? Oh, here we go, guys. Canada real estate buyers were running out of land? I don't think so, guys. Last year, but now they're running out of money. The Bank of Canada, the BOC, and the Office of the Superintendent of Financial Institutions are currently reviewing the limits of covered bonds that can be issued. Banks have become increasingly dependent on these bonds for cheap funding of mortgages. As we approach the limit of these bonds can be issued, regulators are looking to raise the limit. Great problem solved. Expect there's a few tiny issues in raising the limit here. Canada's covered bond program, uninsured mortgages in Canada are funded by a variety of sources, but senior notes and deposits are the big ones. Senior notes are unsecured and consequently have to pay a nice premium to be paid out. After all, if issuer goes bankrupt, there goes your investment. Investors need a small risk premium for that. Deposits need cash, which only grows as quickly as your clients can make money. No one's making money. No one's got money anymore. Neither method can scale at the rate of banks push mortgage growth post-Great Recession. That's when Canada got covered bonds. Covered bonds are used to fund uninsured mortgage lending issued by financial institution. The debt remains on the bank books, but are also covered by the mortgages themselves. In the event the investor aren't paid, they have dual recourse. That means they can go after the bank and have a claim against the mortgages. The bank and the mortgage going belly up at the same time is unlikely. Yeah, right. They always say unlikely, but watch what happens. So this considered ultra-secure investments have low yields, making them perfect for a lot of lending. So ultra-secure investments are probably the ones that people are good and have good jobs and they're not overly invested in. I guess the investor's not over-invested or over-leveraged. The rise of Canada's covered bond market, virtually non-existent in Canada before the Great Recession. Covered bonds seemed a rapid growth in 2007. Covered bonds funded 1.1% of mortgages in banks by 2017, a number inflated to $140 billion, about 9.1% of bank mortgages portfolios. Most of these are dominated by and sold in euros to European investors. Banks have become increasingly dependent on covered bonds for mortgage funding. So dependent, they need regulators to review how much they can use. So basically, it's like you going into your bank and saying, okay, guys, how much equity do I have left in my house? I need to buy food. Well, sir, you got about $2,600. Give it to me now. I need that equity now. And that's what the bank is doing in reverse. They're going to see, and they're getting in, I guess, highly skilled auditors or regulators to come in and say, okay, take a look at this for us. What can we do? How high can we go? Without over-leveraging. Funding at Canada's Big Six banks. Here it goes. Aggregate funding sources for Canada's Big Six banks. Expressed in percentage points. Here it is. Other liabilities. Who knows? Retail small business deposits. That's it? It should be in and around 50-60%, but that's okay. Okay, let me close this. I don't know why this thing is opening here. Corporate deposits, okay. That should be more than that. Unsecured wholesale funding. Mortgage-backed securities at 4.1%. Covered bonds, 3%. Come on, baby. 2. Common shareholder and other liabilities. So there's the common shareholder here. And then other liabilities is this one here. And then, yeah, we went through all of this. Okay, let's continue here. Covered bond issuance is getting close to the limit. Those 9.1% of mortgages funded by covered bonds represent between 2.9% and 3.3% of total assets at the big six banks. Oh, Christ, are you serious? Banks are currently limited to a covered bond issuance of 4%. The BOC estimates that gives banks room to issue another $50 billion of the instrument. Guys, they're using these tools that should only be for severe emergencies only. Oh, God. For context, Q1 2018 showed $26.5 billion in uninsured mortgages, originations, and traditional lenders. Just in the Greater Toronto now, covered bonds aren't only the secure funding for these mortgage. Banks have been increasingly dependent on them, though, not leaving a lot for room of growth. Canadian mortgages backed by covered bonds. There it is. Holy smokes, it's getting up there. Holy smokes. Watch when the 2018 numbers get in. Canada Mortgage and Housing Corporation website registered issuers regulatory filings of Canadian banks and bonds of Canada calculations, says Better Dwelling. Rather than banks going other sources of funds, regulators want to raise that limit. Earlier this year, the OSFI cryptically announced they were taking a hard look at this limit. When we asked directly, they could confirm if that meant higher or lower. Oh, wow. The snitches of the BOC weren't so tight-lipped, instead explaining it would be an upward revision. Oh, God. Hey, we're not raising the debt ceiling here, but we're still going to increase our debts. But we're not increasing the debt ceiling, but we're increasing our debt. They're kicking the can down the road. This is the perfect storm. This is what I've been talking about the whole time. It starts in the housing sector, and then when the banks start losing it or losing their minds and finding out ways to free up more liquidity, they start doing this Mickey Mouse crap and using big words to make the people feel that they're secured and that their investments are tightly sealed and they don't have to worry. Riskier than we're letting on. Sounds great. Let's just raise the limits and we'll be good. No, exactly. It's a huge risk. If they aren't sure that the Canadian economy is booming and real estate prices are stable, cover bonds as well. Covered in the event that the asset in the cover becomes non-performing, it gets. So basically, it's covered, right? So if something happens, you can get your money, right? It gets replenished. The banksters, if mortgage uses for covered defaults, they have to replace it with a good one. That mortgage is likely to come from the bank's unsecured pool. Oh, God, back to unsecured pool. No! Remember, when we discussed uninsured mortgages coming from expensive senior notes or deposits, those less profitable mortgages get moved to the covered pool in this event. Oh, God, really? This can potentially create a higher ratio of unsecured debt, which is also a subject of its own limits. As the BOC's Tony Onhart noted, increases of challenges of the bank faces to responding to rapid depositors or withdrawals, or the failure of unsecured debt holders to renew their debt. Guys, how much you want to bet we're going to have a Greece in Canada where you're going to be limited to how much money you're allowed to withdraw? And then bail-in's looming. Watch my bail-in video. I'll leave a link at the end of this video so you can watch my bail-in video. And I'll leave a link in this video so you can watch the other one that I did about mortgage-backed security. So you guys can be on top of what's going on. Thank you, Better Dwelling. Let's continue here. The rapid withdrawal of cash does not seem like a real scenario to the average consumer. After all, unemployment has never been lower and wages booming. Has anyone seen what happened in Oshawa the other day? However, growth of the M1 supply near cash is quickly slowing. As interest rates climb, the indicator is likely to show further slowing cash deposits. That's right! No one has money to deposit, so there's no more fractional reserve lending, so the banks are running out of money. The recent phenomena of Canadians using high interest rate and subprime loans and buying negative carry real estate investments further depletes deposits in the event of economic hiccup. People are also need to draw on savings. Also, this makes rapid withdrawal scenario more realistic. But rapid withdrawal scenario is a runoff on the banking cash, a runoff on cash. So that's what's happening right now in China. They're doing a good job keeping it under wraps. But that's what's happening right now in China, and it's scary. Why? Because there's about 403 millionaires living in China, and that will affect a lot of what's happening here. Okay, regulators are considering doing one of the most Canadian things I can think of regarding debt. Forget limiting the growth to income and other traditional methods of funding mortgages. So they're going to be lax on mortgage lending now, eh? That would require banks to stop handing out mortgages to everyone that walks into a branch. Instead, they're looking to rise the limits on how many covered bonds can be issued. That is scary, people, especially when they're going to start deregulating the mortgage system to allow people to come in and borrow just by walking in and paying your electricity bill. Hey, I'm here to pay the electricity bill. Sir, we got you approved for a mortgage. Sit right there in my office. I'm here to pay my electricity bill. No, you got a mortgage approved. Go sit right there. And this is going to become a massive problem to keep the Ponzi scheme going. Guys, don't forget to subscribe and let me know what you guys think about the channel. And yeah, I love you guys. Thanks for the support. And don't forget to hit the subscribe button.